Chapter 8, Value of the Supply. Value of supply is outlined in Article 34 to 42 of the VAT law. The regulation stipulates certain conditions applicable to determine the value of supply in special cases. So there will be a separate article on special cases. Consideration wholly in money. So consideration is the amount of money or other quantifiable benefit exchanged in a sales purchase transaction usually. Consideration is all that is received or expected to be received for the supply of goods or services, whether in money or other acceptable forms of payment. So that's the definition of consideration. Where the consideration is wholly in money, the value of the supply is the consideration paid less the tax. So, straightforward, value of the supply will be the consideration paid less the tax. So there will probably be a reverse calculation of how much is the VAT. That amount will be excluded, and the remaining will be considered as the value of the supply. Taxable person must display prices inclusive of the VAT. However, the exception to this rule is set out in Article 27. The regulation states that the taxable person may declare prices exclusive of tax in the following cases. So, which cases? Supply of goods and services for export, where the customer is registered for VAT. So in these cases where the supply of goods and services is in lieu of exports, and where the customer is registered for tax, uh, in this particular case, the taxable person may declare prices exclusive of tax in these scenarios. As an exception to the above, the taxable person shall declare the price exclusive of tax in the following cases. Which cases? The supply of concerned goods or concerned services which are subject to reverse charge mechanism. So naturally there will be a requirement to declare the prices exclusive of tax in case of concerned goods or services which are subject to RCM. If a registrant makes a taxable supply of any crude or refined oil, unprocessed or processed natural gas, or pure hydrocarbons in to another person who intends to either resell these goods or use these goods to produce or distribute any form of energy, provided the reverse charge conditions are met, then in that case, again, taxable person shall declare the price exclusive of tax. So there are more conditions attached to this clause on the hydrocarbon, but probably I'll look at this later. So let's discuss calculations and pricing conventions. So given that VAT inclusive price of a standard rated supply, uh, you can calculate the VAT or value of the supply as follows. So it's simple. The VAT element is 1 over 21. Why are we calling it 1 over 21? Because of this ratio. 5% divided by 105%. Why is that so? So what we are assuming is that the total money that has been paid, the price that has been paid, it is inclusive of VAT. And if it is inclusive of VAT and VAT being 5%, that means the total money that was paid or received is 105% of the value of the supply. So how do we determine how much tax is there? Simply divide 5%, which is the percentage of the VAT standard rate, divided by 105%, which denotes or which represents value of supply plus the value of the VAT, because we are assuming right now that the money paid or received includes the VAT. So this is 105% of the value of the supply. So this ratio 5 over 105 simplified equates to 1 over 21. The fraction is a simplification of the tax fraction. Secondly, the VAT exclusive value is 20 over 21. Yeah. So if you want to find out what is the base value or the VAT exclusive value, so simply multiply the consideration or the price with 20 by 21. So it will give us the exact amount of the price in the total consideration paid. A retailer, if a taxable person, will be required to display goods showing the VAT inclusive amount as the price. So all the retailers are required to show prices inclusive of the VAT. They have to disclose it. The wholesaler will generally show the VAT exclusive amounts of goods. Uh, A simple example has been given. Calculated the tax to the nearest fills for the following supplies made in 2024. Assume that the standard rate is 5% applies to each supply. For example, Mark and Steve sells a ladies coat at AD 99. So if it is, we should be able to calculate it pretty easily. Let me see if I have the calculator. So, okay, where is that? Uh, uh, how much was the amount? 99. So what we will do is we'll take 99 or simply into 1 over 21 or divided by 21. Divided by 21. What do we get? 4.71 will be the value of the VAT inclusive in this price, and minus 99. So basically 94.28 will be the value of this price, will be the value of the supply. Similar rules will apply on the other two as well. Consideration not wholly in money. There can be a situation where the consideration or the price is not paid in money but in an in-kind manner. What do we do in that scenario? Where all or part of the consideration is not monetary, the value of the supply is calculated as the overall monetary part plus the market value of the non-monetary part of the consideration. That's a very good and fair way. Not Note that the market value should exclude VAT naturally. So it will be, so the price has or the consideration has two components. One is the money that is or will be paid, and the second is the non-monetary part of it. So for that non-monetary part, we have to find out what is the market value and add the two components together. And that market value should be exclusive of VAT. Now, market value has been defined in Article 21 of the Executive Regulation as the consideration in money which the supply would generally achieved if supplied in similar circumstances at that date in the UAE. So, being a supply freely offered and made between persons who are not connected in any manner. So, independent third parties basically. It's a it's an arm's length principle compliance. So that is the market value between knowledgeable, willing buyers, not under duress or under a forced sale scenario. And that's about it. This is the definition of market value. Where it is not possible to establish the market value of the supply by means described above, it is necessary to consider the market value of a similar supply taking place at the same time. So, where it is not possible to establish the market value of the supply by means described above, it is necessary to consider the market value of a similar supply taking place at the same time. So, that's a key thing. There may be scenarios where a particular type of uh, goods that are being supplied, there might not be precedents available for the exact precise same thing, but a similar transaction or similar supply might do the trick at that time. Naturally, there might be slight adjustments to the value or other features, but that would be the closest approximation of the market value. If this does not provide a value, we next look at the replacement cost of the same supply made by an unconnected supplier of identical goods or services. So if market value is not available, then naturally we follow the CRC, current replacement cost principle. So we look at the situation as to what will be the cost to company if we have to replace this particular, commodity or service or goods. Special rules are there. What are those special rules? Article 35 to 42 of the VAT law makes provision of provision for special valuation rules for the following categories. What categories? Imported goods. Now that's an easier one. Why? Because there is customs involved, right? So the value of imported goods is the customs value under the customs legislation. That's why I said it is an easier one, because customs legislation is a very detailed one and provides a precise manner of determining the value, including the value of insurance, freight, and any customs fees and excise tax paid on the import of the goods. Note that this amount should not include VAT. That is the valuation rules of imported goods. Now we are coming to taxable and deemed supplies to related parties. Now that's the key point here is related parties. How do we value? The value of supplies made between related parties is the market value. That's the overriding principle. If one has to remember it, remember the words market value. If the value of the supply is less than the market value, uh, if the recipient cannot recover the VAT paid on the supply in full. So, if the recipient of the goods cannot recover the VAT that they paid on the on the supply in full, that's a very interesting angle. So, like for example, uh, someone someone had a television set on which the price was, let's say, 100 dirhams, and for that there was a VAT of 5 dirhams. Now you supply the same television set for, let's say, 80 or 90 dirhams, right? So the amount of VAT that you'll be charging to the related party is only 4 or 4.5 dirhams, but you paid 5 dirhams of VAT for that television set. You're not even able to recover the full VAT on that, on this simple transaction on the both legs. So that is a very clear indication that, I mean, this is even below cost. Forget about market value. This is even below cost. So that's an indicator. But what is the rule? Rule is that if you are selling the same television in open market to third parties, what would ordinarily be the price that you would charge? That would be the market value. That is the value on which you will apply VAT while you're making supplies to related parties. Now, the topic of deemed supplies. So, what is deemed supply? First of all, we need to remember that deemed supply has been defined in Article 1 of the Decree Law, and within the definition of deemed supply comes the taxable supplies. So, deemed supply is a type of taxable supplies. The value is the total cost incurred by the supplier for making the deemed supply of goods and services, originally bought for business purposes but subsequently not used for that purposes. but subsequently not used for that purpose. So that's a deemed supply. So note that this is uh, overridden when the supply is between related parties, for which the market value rule continues to apply. So if you know in if in a business, if the planned usage changes from business to non-business purpose, then it is seen as if a supply has taxable supply has taken place. But if that is the case, if the two parties involved are related parties, meaning the supplier and one to whom the supply is made, they are related parties, then we will not apply the cost principle, but we will look at the market value of the deemed supply, for which the market value rule continues to apply. A very important topic of discounts and subsidies. When discounts are granted before or after the date of the supply, before or after the date of the supply, or subsidies are provided by UAE to the supplier for that supply, the value of the supply has to be reduced in proportion to such discounts or subsidies. This category is addressed in later chapters, yes. So it's a very straightforward thing. 100 dirham transaction, you give, let's say, 5% discount. By default, the value becomes 95. On that, you apply VAT, that's it. Supply of vouchers. Now, it's a very important angle because voucher is seen as basically transformation of cash into another, right, which is called voucher. So kind of a cash equivalent. The value is the difference between the consideration received by the supplier and the advertised monetary value of the voucher. So advertised monetary value of the voucher means this it was originally 100 dirhams. We converted it into a right of you being able to buy anything from our store worth 100 dirham. So if effectively it is cash equivalent, right? But there can be a situation that some although the voucher has a monetary value of cash equivalent value of 100 dirhams written on it, that is the advertised or displayed value. But imagine a scenario where there is a Black Friday sale, for example, and only the holders of these vouchers are allowed to enter into the uh, Tesco or other supermarket, right? Now, people will become crazy to get into that Black Friday sale, because there, if they just are able to enter or gain access, they'll be able to get hundreds, thousands of dollars of merchandise free of cost. Why? Because of the excuse of of holding this voucher, although it is only 100 dirham displayed voucher. The value skyrockets. The people would be willing to pay even $1,000 for this 100 dirham vouchers. 1,000 dirham they'll be able to pay. So this difference between the consideration actually received and the one that is advertised, that will be seen as the value of the voucher. Value is the difference between the advertised, monetary value, cash equivalent value, and the actual money which is received by the supplier. So that's the vouchers. Postage stamp, the value is the cost of the stamp. That's a straightforward thing. Uh, Temporary transfer of goods. So what do we do in this scenario? From mainland UAE into a designated zone or outside the UAE for repair or manufacturing completion, the value of the supply when re-imported back into the UAE is the value of the services rendered. That's it. So this temporary is transfers are usually out of the scope of VAT, right? So in that particular scenario, it's the value of the supply will only be that value addition, because the repair or maintenance or whatever. So that will be the value. But temporary transfer of goods from mainland UAE into a designated zone or outside the UAE for repair or manufacturing purposes. That's the value. Now about discounts. The VAT treatment of supplies made at a discount is stipulated in Article 39 of the VAT law, which also outlines the VAT treatment of subsidies provided by the UAE. So what does it say? The VAT treatment of supplies made at a discount is stipulated in Article 39. So yeah, I mean, Article 39 of the VAT decree law has a bit more details on it. But it's not a very complicated topic. The value of the discounts and subsidies reduce the value of the supply in proportion according to the conditions and restrictions in executive regulations, Article 28 of the executive regulation. Now, Article 20 of the regulation states that the UAE will not be treated as providing a subsidy to the supplier if the subsidy or part of it is a consideration for a supply of goods or services to the UAE. So what does it say? Let us read again. Article 20 of the regulation states that the UAE will not be treated as providing a subsidy to the supplier if the subsidy or part of it is a consideration for a supply of goods or services to the UAE. So you know you if a foreign supplier is supplying any merchandise or goods or to UAE, to a customer inside UAE, and if there is a subsidy provided, so i- UAE will be treated as UAE will not be treated as providing a subsidy to the supplier if the subsidy is a consideration for a supply of goods. So consideration meaning if the subsidy is being treated as the price of the for the supply of goods or services to the UAE, then UAE will not be seen as providing that subsidy. Where a discount is given upfront of the date of supply, the discount offered will be shown on the tax invoice. So that was a discount at the date of the supply. So that was a kind of a trade discount. Uh, Article 59 of the regulation says that discount has to be displayed on the tax invoice, and the value of the supply will be reduced in proportion to such discount, provided the following conditions are met. What are those conditions? The customer has benefited from the reduction in price. The supplier funded the discount. Yeah, I mean, so straightforward. Usually, in majority cases, the whatever the discounted price is written, that's the only price that the customer will pay. And what else? Another common type of discount is a volume-based discount, where a discount is offered over a period of time if a certain purchase threshold is met. Now, volume discount, that's a very interesting angle because that means a certain volume must be achieved before that discount is entirely vested and becomes active. So, in such situations, as a discount is offered to customers against purchases made in the past period, the suppliers would be required to issue a tax credit note to the customer to reflect that discount. So very interesting angle. So multiple purchases made by a particular customer so much so that it reached the threshold where the discount is now effective and activated. At that time, the supplier will have to issue a tax credit note to one of the suppliers. Core care should be taken not to confuse a discount with a barter transaction. Now, what is a barter transaction? In case of barter transaction, the price paid in cash may be reduced, but there is something else provided in return. So, how? Therefore, there are two supplies to be considered, and this is not a true discount. So many trade-ins are happening Apple Store, you know, Alpha, you know, Ford Motors, all those major, companies that allow trade-ins. So in those cases, what will happen is that we will have to carefully look at the values of the supply. An example might be where a hypermarket rents prime shelf space to a customer. Right. So, what we were talking about was trade-ins, right? An example might be where a hypermarket rents prime shelf space to a supplier, and the cost of the rent is set off against the cost of goods sold. Cost of the rent is set off against the cost of the goods sold to the hypermarket. So the supplies need to be considered on a case by case basis on the facts of each case. So yeah, I mean trade-ins and exchange and barter transactions mean there are always, two suppliers. So we have to be careful about it, not to confuse barter transaction with discount. Exchange rates. Article 69 of the VAT law deals with exchange rates. If the supply value is expressed in a foreign currency, the amount must be converted into UAE dirhams based on exchange rate approved by the central bank at the date of supply. This is a very, very important point because in various courses such as the UAE VAT diploma by ATT, this has been examined hundreds of times. So there are questions on determining the tax point or date of supply. So we have to be very clear that the exchange rate that will happen it will pertain to the date of supply. Now, date of supply rules, again, they are different. They are addressed in a different article. What are those? In general, in a summary manner, it is the earliest date or the date of actual delivery of goods or the date of tax invoice or the date of payment or sometimes in the date of acceptance, etc. So earliest date when any of these key trigger points were uh, uh, you know activated, that will be the date of supply. And that date, once it is determined, whatever was the exchange rate prevailing on that date, that will be taken in as the exchange rate for the particular transaction. The AED amount has to be reflected on the tax invoice issued in respect of the supply. Naturally, that's AED is the national currency. So as per law, it has to be reflected. So it's okay, fine. Let us go through an example, small example. Jamal sells goods of 1000 exclusive of VAT to ABC before any discount. Jamal offers a 2% discount to ABC LLC. Calculate the VAT on the discounted value. Straightforward. 1000 minus 2% would be how much? So 1% would be 10, 2% is 20. So 1000 minus 20, so 980 dirhams. So calculate the VAT due. So 980 into 5%, whatever the amount, that's what it will be. So I think 10 dirhams will attract 5%. So 50 fills. So it will be basically 49.5 fills. Anyways, let's go to the VAT free retail offers. So a very interesting angle. In response to offers or promotions advertised as VAT-free special offers by retailers to entice prospective buyers to purchase within the promotional period, the FTA has issued a public clarification. VAT-free special offers. The term VAT-free in this context is misleading. Although the seller may choose to absorb the VAT, reducing the price for the buyers, the supplier is not free from VAT naturally. In such instances, the actual amount charged to the customer is regarded as VAT inclusive. So, the amount that the customer will pay, that will be seen as VAT inclusive. Reverse calculation will be done to estimate how much amount of VAT is there and must be reported in the VAT return. Example, a motor vehicle's normal price is 105 1,000 dirhams, the dealer runs a special VAT on a promotional price of 100,000. Calculate the VAT due in relation to the promotional price. So what we will do is the actual total money that the supplier is receiving, the dealer is receiving is 100,000 dirhams, right? So if it is VAT inclusive, what we will do is we will simply multiply it with 5% and divide it by 105%. Or in other words, we will simply divide it by 21 VAT fraction, and that will be the answer. Okay, let's go to the next topic, which is single and multiple supply. So the UAE VAT legislation makes specific provision for the treatment of single and multiple supplies in Article 47 of the VAT law, subject to Article 4, uh, 26, and 46 of the regulation. So what we are talking about right now is single and multiple supplies. So where a person makes a supply consisting of more than one component for one price, the person shall determine whether the supply constitutes a single composite supply or multiple supplies. So very interesting angle. It can be a combination of goods and services and packaged or bundled as one. A single composite supply means a supply of goods or services where the supply consists of more than one component, considering the contract and the wider circumstances of the supply. Some more discussion. A single composite supply exists in the following cases where there is a supply of all of the following: a principal component, something which is provided principally, major thing, the flagship, a component or components which either are necessary or essential to the making of the supply, including incidental elements which normally accompany the supply but are not a significant part of it, or do not constitute or aim in itself, but are instead a means of better enjoying the principal supply. And one more angle, one more point, where there is a supply which has two or more elements so closely linked as to form a single supply, which it would be impossible or unnatural to split. It will usually be a single composite supply. Where there's a supply which has two or more elements to so closely linked as to form a single supply, and it would be quite unnatural or even impossible to split. It usually will be a single composite supply. Now, in order for a single composite supply to exist, the price of the different components of the supply must not be separately identified or charged by the supplier. And all components of the supply must be supplied by a single supplier. So because we're looking at it as single supply, all single composite supply. So the price must not be segregated. It must be supplied as a bundled package. Note that where a supply is a single composite supply, the VAT treatment of the supply shall follow the VAT treatment of the principal component of the supply. That's a very, very important angle. The if the principal component, for example, is zero rated, the chances are that the ancillary or other secondary components or subsidiary components will be also, they will be treated at the same rate of tax, and vice versa. If the principal component is a standard rated or for that matter exempt supply, the subsidiary components might be considered. But yeah, it can quite happen that sometimes those additional components that are being offered, they might not be entirely of an exempt nature, but that will be determined on a case-to-case basis. So, uh, what were we reading? Note that where supply is a principal component. On the other hand, if a single component does not contain a principal component, the VAT treatment will generally be applied based on the nature of the supply. Any supply of two or more elements that do not have the characteristics of a single supply would be considered a multiple supply, where a supply consisting of multiple components is not a single composite supply, where the price for each component is separately identified in the contract. The supply of each component is to be treated as a separate supply. So that is what is a multiple supply. The supplier must identify the value of each component based on the market value of each part as per Article 25 of the regulation. Article 26 of the regulation. Okay, let us look at the example. Um For each of these supplies, decide whether there is a mixed or multiple supply or a single composite supply. A state school supplies a a curricular course and some books. Now there is a course which is a service, and then there are books for extracurricular activities are supplied for an additional fee. Books for extracurricular activities are supplied for an additional fee. So there is a principal component. State school supplies a curricular course, and some books for extracurricular activities are are supplied for an additional fee. Curricular course and additional fee books and active for activities. Uh, Tickets to fly, and here, by the way, the prices are also separate. So if you really ask me, it seems that this is a multiple supply. But let's look at the ticket to fly to Italy, including a standard lunch where the price is inclusive of the meal, no additional fee for the meal. That's a clear-cut single composite supply. So it is one supply, one price. Here, there are clearly two prices. This is multiple supply scenario. Now we need to understand there is a guide on this matter as well, maybe a public clarification. We will have to look at it. Disbursements versus reimbursement. So in commercial transaction, a person may incur expenses and then recover these expenses from another party. The VAT treatment of the amount recovered depends on whether the recovery is a disbursement or a reimbursement. Now, how do we, first of all, explain the words disbursement and reimbursement? The difference between these and their VAT treatments are explained in the public clarification issued by the FTA. We're going to look at it. Disbursements refers to the recovery of payments made on behalf of another person. Okay, so here it's very crystal clear that the payments are being made on behalf of the other person. The disbursement of expenses is outside the scope of VAT. So, I mean, it was not even our expense. We didn't get any benefits. We didn't, do any supply. We simply did a payment on behalf of another person. That is called disbursement. This is because these expenses are not incurred by the taxable person for their own business. So it's another person's business. This would include a payment that a business makes on behalf of a client, but for which the client is later invoiced by the business. This would include a payment that a business makes on behalf of a client, but for which the client is later invoiced by the business. Um, Let us look at the certain other aspects. The following principles help determine whether the recovery of an expense from another party satisfy the conditions for being classified as disbursement. Okay. The other party should be the recipient of the goods or services. So think of a scenario where there's a parent company and then there's a subsidiary company. uh, Parent company is making payments on behalf of the subsidiary, right? So in this situation, other party, which is the subsidiary, they are the recipient of the goods and services. So like it's like a child and a mother, and a child has done bought something and asking mother, please pay, please pay. So it's just like that. So the subsidiary has, enjoyed certain expenses and benefits out of it and asking mother to pay. So parent company. The parent company will pay, uh, but they have not received anything against that money paid. The other party should be responsible for making the payment to the supplier. Yeah, in this scenario, naturally it is the subsidiary that is legally responsible for settling this debt of the supplier. Whatever they purchased, they have to settle. But who did the actual settlement on behalf of the subsidiary? It was the parent company. Third condition, the other party should have received an invoice or tax invoice in its own name from the supplier, naturally. So because this subsidiary, they have received invoice or tax invoice. So, uh, you know, it is very clear that the onus and responsibility of this transaction belong to the subsidiary. One more angle or one more point was the other party should have authorized the payment to be made on its behalf. So there was an actual authorization uh, by the subsidiary to the parent that yes, yes, we are okay. Please do pay this money on our behalf. The goods or services paid for should clearly be additional to the supplies made to the other party. Right, and the goods or services paid for should clearly be additional to the supplies made to the other party. So let's say they have a prior relationship. So this payment should very clearly be an additional payment. If there were already some other supplies going on between the parent and subsidiary, this should be a crystal clear other payment. The payment should separately be shown on the invoice, and recovery should be of the exact amount paid without a markup. So parent cannot charge markup on that. So the payment should separately be shown on the invoice. So on the invoice you can write how much amount of money did you pay the parent company on behalf of the subsidiary, and do not write a markup. So otherwise there will be a VAT. So recovery should be the exact amount paid without a markup. Now this on and by the way, they did not write on the tax invoice. It's written on the invoice. Now let us look at the reimbursement. Refers to the recovery of expenses incurred as a principal. Okay, so this is a different scenario whereby uh, it's a reimbursement scenario. Refers to the recovery of expenses incurred as a principal. So, when reimbursement of expenses falls within the scope of VAT, a reimbursement is considered to be a part of consideration for the supply and follows the same VAT treatment as the main supply. So let us have look at the condition and it will start making sense. The following principles help determine whether the recovery of an expense from another party amounts to reimbursement. Now, so think of a scenario that uh, there is a parent, there is a subsidiary. The first party, the party seeking reimbursement, should have contracted for the supply of goods or services in its own name and capacity. So the subsidiary was in a peculiar situation and they could not have opened, let's say if it is a utility bill scenario, utility scenario, they could not have, they were barred from opening a DIVA account. So what did parent do? Parent opened it in their own name. They assumed all the risk, right? So, but this electricity was, it was confirmed that, on this particular premises, this additional account opened by the parent, it will be in the parent's name. So, but the benefits were being enjoyed by the subsidiary, right? Only the account was opened in the parent's name. So, it should have contracted for the supply of goods. So parent contracted. In this particular case, parent contracted. The first party should have received the goods or services from the supplier. Yeah, it is in this scenario that I am talking about. Subsidiary is directly receiving all the utility like electricity, water, etc. Um, directly from Dubai Electricity Diva. Okay, the supplier should have issued the invoice in the first party's name. So the name, so the name that was issued, it was the first party's name, with the first party legally obliged to make payment for it. So uh, the first, in this particular scenario, the first party is the parent, not the subsidiary. Okay. Uh, so the okay, we need to change the example. The electricity will not work because in that particular case, the electricity connection has to be in the premises of the subsidiary. Let's change the scenario. So instead of electricity, we can talk about the trade, some merchandise or inventory purchase situation. Okay. So the first party, the party seeking reimbursement, so they were the ones, the parent company was purchasing the inventory. Okay. So that was the situation. And so they were purchasing inventory on behalf of the subsidiary, right? Should have contracted for the supply of goods in their own name. So the parent went to the suppliers and they did not tell about subsidiary. They purchased it in their own name. But parent company knew that this purchase we are doing on behalf of the subsidiary and we're going to give this inventory to the subsidiary. Second situation, the first party, which is the parent, should have received the goods or services from the supplier. In this particular case as well, like the parent company would receive the goods and the invoice also. The supplier, uh, sitting somewhere in China or India or wherever, they issued the invoice in the name of the parent, the first party name, with the first party legally obliged to make the payment for it. It was the responsibility of the first party to make the payment for it. Although the group knew, the first party, which is the parent and the subsidiary, both knew that although it is a means to support the subsidiary, all this inventory purchasing is happening for or the benefit of the subsidiary. It will be, the inventory will be given to the subsidiary. In the case of goods, the first party should own the goods prior to making the onward supply to the other party. In the case of goods, the first party should own the goods. So naturally, parent owns the goods prior to making the onward supply. Now, what will be the consequence of this onward supply? The simple answer is the title in the property of that inventory or the goods will pass on, will transfer from the parent company to the subsidiary. That is the whole point of raising a tax invoice. And this is please remember, this will be a taxable supply. It is reimbursements are taxable supplies. So, we can read the example for each of these suppliers, decide whether there is a disbursement or a reimbursement when expenses are recovered. So let us have a look at it. Company A entered into a contract with Company B to provide marketing services. Okay, the contract stipulated that Company A would be eligible to reimburse the expenses from Company B. Company A uh, e- entered into a contract with Company B to provide marketing services. And what was the contract? That contract stipulated that Company A would be eligible to reimburse the expenses from Company B. Company A incurred the expenses in its own name and subsequently recovered the amounts from Company B as per the terms of the contract. Uh, okay, that is one scenario. What is the other scenario? Company A procured group medical insurance from a local insurance company and received an invoice directly from the insurance company. Company A requested Company B to make the payment on its behalf. This now it is very clear. So there was a group medical insurance procured by Company A for the benefit of the Company A itself. But who made the payment? Company requested Company B to make the payment. So Company B was sitting idle and they were oblivious, and suddenly there was a request like, guys, we have done an expense, please pay on our behalf. That's a clear case of disbursement. It's not reimbursement. But in previous situation, Company A entered into a contract, they did the expenses, and then they claimed reimbursement from Company B. So that's a case of reimbursement. This particular case is subject to tax, subject to VAT, but disbursement is not. Thank you very much. That is the end of chapter 8.